So what if a company suddenly declares bankruptcy, and what will happen to your preferred shares? So if the company declares bankruptcy, you have to understand this. You are an owner of a company. You are an owner of a publicly listed company. It just so happens that it's not a common share anymore, it's a preferred share. But if the company closes down, guess what? You are the owner of a company that's closed down. So normally what will happen is they will liquidate the assets. As they start liquidating the assets, people or entities where the company owes money from will be paid first. Whatever is left will go to preferred share owners. We have two types of stock classifications. One is common shares, the one you normally trade in the market, the JFC, the ACs, the SMPH, the SMs, the AGIs. Those are all common shares. The difference between preferred shares and common shares is this. You want cash flow, if you want repetitive gains regardless if the market is bullish or bearish, and you want an expected return, preferred shares are the way to go. So what exactly are preferred shares? Preferred shares is just like a normal stock. It gives you ownership of the company. But the main difference between a preferred share and a common share is basically this. A preferred share will give you a fixed dividend rate. A preferred share will give you a fixed yield already, meaning you have to remember, the longer the tenure, the larger the rate. Because you are exposed to longer years of it being unknown, you should be compensated with a higher rate of return. Does the stock price move up or down? Yes, it does. Why does it move up or down? It's dependent on the interest rates. Depending on the prevailing interest rates in the future, the prices will move. But here's the thing. If you do not plan to sell the stock at any given point up until that particular period, guess what? You won't be subjected to any volatility, meaning what you put in after that period of time, after they use the money already and they return it back to you, you get the same amount from the capital that you invested, plus the dividends that you get every year that they promised. So the Series 3A preferred shares, which is 5.5 years, will give you 6.87% yield. While the longer one, as what I told you, gives you longer uncertainty, is for 7 years, the Series 3B will give you a 7.13% return on your investment per year. So the question there is, among the two, what did I get? Or did I even get at all? Here's the thing. As much as I can, and as often as there are preferred share offerings, I would get it. You have to remember this. Every time I earn from the market, I just put it back in the stock market. I just put it back to buy more shares. But there comes a point in time also that as it starts to grow, you have to pocket some of your earnings. But how do I pocket my earnings? The earnings that I get from the capital gains, the earnings that I get from trading and investing, I get some of them and use that to buy me preferred shares, because the preferred shares will give me passive income for life. The end game, the goal is that you need to have passive income for life, and the way to do that and the way to get that is to have preferred shares, because preferred shares will give you an expected rate of return regardless. So I always get the ones with higher interest rates. I always get the ones with a higher dividend yield, for the fact that I want a greater rate of return, because at the end of the day, even if there's volatility, I have already an expected rate of return. And you have to understand this. I still have money in banks. I still have money in time deposits. I still have money in stocks and bonds. So this is something that's on top. This of course, if you want to grow your money, you have to trade. You want to grow your money, you have to invest in growth stocks. But if you want to preserve it, just buy preferred shares. And here's the thing. If you're too scared of investing and you have time deposits, this is a proxy for it as well. If you're putting your money in time deposits for 5, 10, 15, 20 years and you're not touching it anymore, instead of putting it in time deposits and you're getting 2, 3, 4%, why not just buy preferred shares and then wait for it until it matures, or until the tenure is done, and then you get your money back again and you get a higher rate of return back. Dividends naman is you looking at the company that a portion of the earnings of the company is given back to investors. It's actually like the company saying that from what we earn, from what we have, you have to understand that as companies start to earn, as companies start to make money, a portion of what they earn, they still use to pay off their expenses, to pay off operations. But pag may natitira dun, a portion of that also they would use for expansion, to grow the business, to make the business grow better and expand. But there comes a point in a business of a company where they have expanded enough and meron pang natitira. And you have to understand this from an entrepreneurial standpoint, that if you're an entrepreneur and you have a certain amount of money na sobra na you don't get to use, it becomes money that's relatively stale, relatively not as strong, no, not as useful anymore. So what do entrepreneurs normally do? Since I can't use that money anymore, I might as well return it back to investors, and that's what dividends are. Dividends are relatively certain amounts of money that are sent back to investors. What's nice about dividends is this: companies that are profitable, companies that are earning money, are the ones that give dividends as well. So it kind of makes your filter easier, because you, if you buy a stock that gives out good dividends, you have an ideology already, you have a bias that this company is making money as well. So what do you look for when you're looking for companies that give out dividends? For me, as much as possible, buy companies that give out dividends that are higher than bond rates, that would actually be time deposits as well, because in the stock market you're subjected to more risk already. So the thing about that is, when it comes to buying stocks, at least it should be giving you a certain amount that's higher than bonds and time deposits as well. So what I like about dividends is, even if the markets would go down, markets would drop, as long as the company has a good dividend payout ratio, good dividend policy, you can expect a certain amount of return still. And this is, for me, useful if you plan to retire in the future, you want passive income. As long as you hold the shares, you could get a specific return on a regular basis, as long as you hold on to the stock. I got a lot of questions asking why I love dividend stocks so much, and when dividend stocks are boring. It's kind of true, no? When you do dividend stocks, also, it's not as cool, it's not as fast, it's relatively slow. But the thing there is that you don't do dividend stocks for the purpose of growing your portfolio. You do dividend stocks for the purpose of, you want to maintain, you want to preserve what you have. So the main intention of why I love dividend stocks is the earnings that I get from trading, the earnings that I get from my other positions. So if I make a winning trade, I make a good trade, I do a quick trade also, all of those things, when it's at a certain point already, when I say, hey, this is a good return already, I take a portion of that earnings. As I take a portion of that earnings, that's what I put for dividend stocks. And the whole intention of this is this: my trading, my fundamental positioning allows me also to win and make my portfolio grow, but my dividends give me cash flow that even if the market is bearish, hey, guess what? I still get to get cash flow, and that's what I used to live. So I use my dividends to earn and live from passive income. I use my trading, fundamental investing, for me to be able to grow my portfolio. And that's where the magic is, that it will allow me to survive bear markets, because I know I have expected returns regardless of what's happening in the market. So if you are a person that's super busy, you're a person that doesn't have time to watch your portfolio on a daily basis, you have a job, you have a business, you have something that you can watch, or you don't have time to watch it on a daily basis, but you want something that will give you a better and bigger return than time deposits, better than bonds, preferred shares, dividend earnings are the best way to go about it. And that's what I suggest. You segment the market based on the risks that you're willing to take. You segment the market based on the amount of money that you're willing to take also. That also means that if you're willing to take a small amount of risk, guess what? You must be also willing to take a smaller amount of gain. And that's how it works. The amount of gain that you're willing to take should be dependent on the risk that you're willing to take as well. Meaning, if you can't watch your stocks regularly, you cannot trade as quick and as long and as risky. You can still make money by buying good companies with dividends, and then just live off the passive income that you can get from dividends, and just do it repeatedly over and over and over and over again. And the advantage about that is this: 60% of the time, majority of the gains on the broad market over a stretched period of time, capital appreciation from that comes from stocks that have large dividends. So what if a company suddenly declares bankruptcy, and what will happen to your preferred shares? So if the company declares bankruptcy, you have to understand this: you are an owner of a company, you are an owner of a publicly listed company. It just so happens that it's not a common share anymore, it's a preferred share. But if the company closes down, guess what? You are the owner of a company that's closed down. So normally what will happen is they will liquidate the assets. As they start liquidating the assets, people or entities where the company owes money from will be paid first. Whatever is left will go to preferred share owners. Bastasa says, so it means preferred shares are similar to bonds. Correct me if I'm wrong. Besides, I didn't understand why I didn't mind, and I also need 50K for initial capital. Oh man, it's almost like bonds, but the main difference lang is this: bonds is a debt. Preferred shares is from the earnings. It's basically dividends. So bonds, they owe the people money, or they owe the investors money. Here, you will get a portion of the profit. So that's what I've mentioned in the first question, that if the company would close down, bond payers get paid first than preferred share owners. So it's similar, but the main difference is that they're not paying you debt or interest. They're giving you portions of the income that's relatively fixed. So if they have a good CFO, they already can compute already what they will possibly earn over the next few years, and then that benchmark also is their basis of their computation that they can give you the dividends. Because the thing about that is, if the company is not doing so well but they're still earning naman, they will give preferred shareholders their dividends, but common shares, they may not get dividends anymore. You have to remember, common shares are the lowest rung in terms of them getting earnings and dividends. Next, I am Jam 101. Any sample computation for dividend earnings for this? It would be nice if you can send me the income that you would have, kasi it's pretty much straightforward. When it's not income but the capital that you would put in, it's pretty much straightforward. If you place 100,000 and the yield is around 7%, so you get 7% of 100,000 less the taxes, which, by the way, I'm getting ahead of myself already. I saw a question about that, which is 10%. By the way, one of the biggest advantages of preferred shares up against bonds, up against time deposits, is that the taxes are not 20%. You have to remember, the withholding tax for bonds are 20%, but the withholding tax for this is only 10%. So that alone will give you a larger buck for your money na rin. So that's one of the advantages of it. Sir, is it possible to sell preferred share at a higher value if the stock price increases? May appreciation rin po ba sa maturity date kung tumaas value ng stock? Two things. If the stock price at the time that it is in the market is higher than the price that you bought it, of course, by all means, you can sell and take profits. It's just like any other stock that you can get in the market. It really doesn't change. The volatility or the movement of it is pretty much predicated on on interest rates. If interest rates are better today than what it was before, of course the rates that you will get, or the price of that stock will be lower. And if the flip side will happen, you get to sell it also at a higher price. But if you hold it until maturity, if you placed 100,000 pesos, guess what? It will still be 100,000 pesos still. What are the risks of preferred shares? What does the fundamentals affect this kind of investment? As mentioned already, if the company closes down, of course, they can't pay you anymore. You don't get your dividends anymore, because dividends are part of the earnings, and if the company closes down, it means that they don't have any earnings. So that's your risk there. How much will be the initial investment? 50,000 is what brokers have been offering. The stock price is at 1,000 pesos per share, so you can peg it from there also, that you get 50 shares for 50,000 pesos. But you can, of course, if you want to get more and earn more, you have to get more shares. Is a dividend withdrawable every year, or do you have to wait for maturity before you can withdraw it all? What if the stock drops 50% after maturity, then the dividend yields are negated? Number one, it won't drop 50%. I don't think it will drop. There's always a potential for it to drop 50%, but it won't. Second is, the dividends are given on a quarterly basis. I guess that's it. That's the last question. I hope I was able to answer all of your questions, and as always, I hope videos like this create as much value for you as possible, because of the goal, the narrative of why I keep doing what I'm doing. That's why I've been doing, if you've noticed it, no, sometimes it's not just one video a day. I post 2 videos, because I just love this. It gives me a way also to communicate my thoughts, and it serves as an outlet also to at least educate you guys on investing, because I really believe that investing is the game. Investing allows you to live life at your own terms. Investing gives you control over your finances. Investing allows you that wherever you are in the world, that you can win, you can make money, and it's not dependent on the government, it's not dependent on the economy, it's not dependent on what you see out there. It's you taking control of your finances. And I really hope that we see more and more Filipinos invest massively and be financially free, because it can be done. You can win. You can be financially free. You can live life at your own terms. You can do the things that you want. You don't have to wait until 60 for you to retire. You can do it right here, right now. And all you need to do is to prepare as much. And people don't like preparing it. People don't like preparing. People don't like to do the nitty gritty. People don't like investments like this because it's boring. Please remember this. Sometimes it's the boring things that will make you rich. It's the boring things that people don't want to do that will give you cash flow in perpetuity.